Welcome to the Daily Update. This is Being Prepared Tuesday, September 27th, where we'll look at the action in the market today and then see how things look for Wednesday, September 28th. And from a technical analysis standpoint, not a lot has really changed. We're still negative. We're still holding up with support. We're still looking extreme negative. We're still seeing some positive signs under the surface. But so far, any attempts that have been made at a rebound, either on Monday's session or in Tuesday's session, have been met with selling. But still, we shouldn't really give up the idea that this could be a plausible scenario right now. We can't really do anything to the upside until we see confirmation based on price. We can't really do an awful lot to the downside right now because we're oversold and we're potentially looking at a bounce. And we can't really do anything sideways currently because the market is in a trending condition. So let's go back and talk about what happened. Right at the open, we did have a gap higher, and it looked like, okay, here we go, here we go. But as is often the case, everybody's all rah-rah at the beginning. This is when they call this the amateur hour. When folks get into the market, they're just doing things based on emotion. Maybe they saw the futures before the market opened up and they're all ready to go with things. And then that wears off after the first 1 to 2 hours. Things settle down a little bit. And then with about 1 to 2 hours left to go in the session, that's when the professionals come in and take over and do what they're going to do. But we did gap higher at the open and we went above R1 at 36.99, almost at that 3,700 level. Prices then fell down to the daily pivot at 36.72, but they rebounded back to R1. But we stopped right at R1. You can see this is a real technically driven session. We were bouncing around pretty good here. As the day went on, prices then fell below the daily pivot. They fell below the unchanged level, and that took prices negative, and we went down to S1 at 36.28. S1 did hold. And then prices bounce back up to the unchanged level, which is a built-in resistance level on a down day. Going into the close, we drifted lower and stayed negative. And by the time we closed, we set yet another 52-week low on a closing basis. And we did take out the lows of yesterday and last week. We ended up being down 0.21%. Now, we were mixed across the board. There were some indexes that were up on the day, but the S&P still settled down in the session. Volume continues to be above average. And as I stated, the technicals are negative, but we're kind of in that in-between land still where we've been for the last few sessions to really see a conviction one way or the other because of inflation and interest rates, both inside the US and globally, that we're seeing. We did have some Fed speak, and I'll go through that here in just a moment. Some comments: stocks looked to rebound early, and the NASDAQ was up over 2% at one point, and the S&P itself was up over 1%. Stocks are still being heavily influenced by currency movements, specifically the British pound. There's some issues going on in the UK right now, and that's feeding over into the euro, which is also feeding over into the dollar, and it's just having kind of an impact on things right now. And I do have another chart of the British pound, and there was some Fed speak that came out, but I'll go through that in the next slide. The US dollar, it continues to go up, and it's still outperforming oil. If you go all the way back to the beginning of the year, many indexes are still hitting new 52-week lows, and that's not positive, but we're oversold on the short term, intermediate term, and even a few of our long-term indicators are still giving us this extreme negative reading. It doesn't mean we have to stop here, but it does look like we're slowing down a little bit. We're seeing a bit of exhaustion because there's really no reason in the world why stocks should go up. And if you've been following the markets for a while, that's usually when they do go up. If that ends up happening, we still have those same yield curves that are inverted: the 30-year to the 5-year, the 10-year to the 2-year, and the 10 to the 5-year. The one that we've really been watching, the 10-year to the 3-month, that is not inverted, and it's actually looking a little more normal right now. Sentiment is still pointing over towards the fear side of things. And even though it didn't really change from yesterday's level, we're still pretty apprehensive about things. And when it gets to this extreme level, this is when we use that as a contrary indicator. We did have durable goods that came out, and that fell 0.2%. They expected it to be down 0.1%. So that was weaker than expected. If you take out transportation, it rose 0.2%, which is not as much as they thought it would be at up 0.3%. So this report says that we're hanging in there, but it's weaker than what they thought it would be. The FHFA housing price index fell 0.6%. After the last time we got this report, it was up 0.1%. The S&P Case-Shiller home price index, it was at 16.1, less than the expected 17%. And last time we got this report, it was at 18.6%. And consumer confidence, it actually rose. Maybe something to do with the employment situation is still looking pretty good. Maybe some gas prices have to do with that a little bit. So it came in at 108. They expected it to come in at 105. The last time we got this reading, it was at 103.6. New home sales were up. This is kind of interesting. I think you can probably guess why this is happening because they rose 28.8% on a month over month basis. If folks are going to get into a house, plus it's the end of summer, and that's usually when people like to go out and look at houses, and they want to get in before prices keep getting higher, before interest rates keep going up. And so they want to lock things in right now. And this was on a seasonally adjusted annual rate of 685,000 units. This is way more than what they expected at 500,000. Then on a year-over-year basis, new home sales are down 0.1%. Our trend is still negative and above 20. With the down day, we continue to have a bias of being negative. And the last 2, 3, 4, 5 days, of course, have been negative overall as well. So our momentum continues to be negative. So some of the Fed speak that came out. Chicago Fed President Evans, who's not a voter on the FOMC, acknowledged to CNBC Europe, didn't even talk to the US portion of the network, that he's a little nervous that the Fed is moving too much, too quickly, but added that he remains cautiously optimistic that the U.S. can avoid a recession. Well, a lot of people say we're already in a recession. It's too late for that, according to the textbook definition, but they're also really looking to employment staying pretty solid right now. Now, the other comments were a little bit more negative and a little more hawkish. Cleveland Fed President Mester, who does vote on the committee, said policy rates need to be at a restrictive level for longer to bring inflation down and to make sure inflation expectations do not move up. That's pretty much what Chairperson Jerome Powell has been saying. Then we had the St. Louis Fed President Byrd, who's also a voter, said that the U.S. has a serious inflation problem. You think? And that the credibility of inflation targeting is at risk. Remember, transitory. This is just transitory. You got a lot of folks that really are suspicious of the Fed now because we were told that inflation was transitory. Turns out that was not true. It's real, and it's getting to be more and more of a problem. Then the Minneapolis Fed Bank president, who's also a voter, said that the Fed is united. Yeah, right. And will move to bring down inflation at an appropriately aggressive pace. Okay. So the first one says, I'm a little freaked out, but he said that in Europe. The last three, they're pretty much reiterating the current stance of the Fed. So that really didn't give a lot of confidence there. There's no pivot in this. You might take the first one, but that person doesn't even vote. We really focus on what does Chair Powell say. All right, let's go back and talk about today's session. We're down at 17, which is the same as the previous reading. I think we were at 19 yesterday. This changes a few times throughout the day, so I'm just looking at the closing value, but we're getting closer to that extreme fear currently. Here's the historical chart showing that we're down below 25. Here's some Isabel Net charts. These metrics say stocks haven't hit their lows. And I highlighted this. This is the current where we have the S&P trailing 12 months PE ratio. And that's what I use in the charts and some of the other videos that I do. It just shows that we're way, way high. We're at between 16 and 20. It's probably closer to 19 or so right now. At least the last time I did the video, we were right at about that level. And the 10-year treasury yield showing right here, and just how big of a difference there is between. Well, when you take all of these different or time periods and you average them together, we can see where the TTM was a lot lower and the interest rate was a lot higher. So this just shows that there's a pretty strong disconnect currently. And to go back to what has historically happened, we need to see the PE ratio come down and interest rates continue to go up. Here's another one that shows the US dollar on a year over year change is at a level that usually leads to financial economic stress. This is because the dollar is strong. The conversion rates are not as good for US companies. That really bleeds through into their earnings and their sales and revenues and things like that, which then ultimately feed over into stock prices. And we can see back here, this goes back about 30 years or so, the Mexican debt crisis. I remember that one. This is about the time when I really started getting into the markets myself in the early to mid 90s. And this is what under President Clinton, and he decided to do something to kind of help that situation. Russia default, of course, then the tech bubble, that's the whole .com boom and bust, housing bubble. Then we had the Great Recession, sovereign debt crisis. This was mainly in Europe. Then where China devalued against the dollar, their own currency. And then we have a bunch of question marks right now. So when the dollar is really shooting up the way it is now, it usually spikes out at something not very positive happening. Then we show that there's still an increase in the bearish funds that people are getting into as opposed to the bullish funds with the RIDEX bear bull ratio. This could still go up higher, but it's starting to get kind of high. And this is at a point where, at least in the past, sometimes that has topped out. This just shows the rising recession risk. These are the yield curves that are inverted. And I only track a few of the yield curves that I show in the videos, but we're getting up around the 60% level as far as those yield curves that are not doing normal things right now by being inverted. This is showing, again, the TTM, the trailing 12-month net income growth. That's the dark blue line, how it's been going up and down, up and down. Well, see how it's been coming down recently. And then here's the Fed funds rate deviation from the trend. And they set this up so it's leading by 2 years here. And it just shows that these lines have a tendency to move together. So as this blue line is coming down, the dark blue line is coming down, we're also seeing the lighter blue line also declining. So that could also be negative. Now, remember, this is inverted. So this is the rates are really going up, but just to make them go more hand in hand, they've inverted the light blue part of this chart. This is showing the expectations for the Fed policies rate, where these are things that have already happened. And now we're coming up into what's still yet to happen. And some folks are thinking that we're going to be raising interest rates quite a bit. This is the Nomura forecast and how they changed that. The lighter red here was a previous forecast that they had. Then you have OIS forward rates. And then this is the median forecast that they're coming up with here, this kind of grayish line. And no matter how you look at this, interest rates are still going up. And that's not really a surprise. They're expecting possibly into the first or second quarter of 2023 for interest rates to finally start to top out and then come down as we go further along into 2023. But this is open to all kinds of changes. If you look at some of the charts that we were looking at a year ago, they would look totally different from where they said we would be right now. So Again, just interesting, something to look at. This is what the market focuses on, but it doesn't necessarily mean this is the way things are going to actually play out. Here is what they're considering to be an alternative. UST bills back above the S&P earnings yield. This is the 6-month Treasury bill yield. And they're actually getting a better return right now than the Fed funds rate currently, where here you have the S&P cyclically adjusted earnings yield. So some folks, this might bring some buyers into the market, which would push prices up and interest rates down. So we may get some support from this. This is just another oversold, overbought composite where I highlighted this, where we're down at about 15.65 right now. We could go lower than this, but at other times, this has marked some kind of a contrarian low in the market where we might see a bounce from this. Here's the on-screen. Oh, this is the E-mini contracts, ES1 futures liquidity, which just shows that it's really been coming down a lot, but still that's a very liquid futures contract that millions of people trade, and the bid ask tends to be pretty close to each other. But it's just showing that as we're not going higher and the markets are whipsawing back and forth, this ends up taking a lot of the newer folks that are involved in the market. It's taking them out of the market because these are highly leveraged, and you can not only make a lot of money pretty quick, you can lose a lot of money pretty fast with this too. But it just shows that basically liquidity is going down right now. This is the Fed funds futures curve, where this is where we're at. This is the current Fed funds rate. They expect it to go up higher. This is the market estimate of what is neutral. And then they see it going up and then into 2023, finally topping out maybe in the spring, according to this chart. And then I should be looking at the blue line and then having it come down because they've actually lowered their expectations. The purple line is what they thought it would be a week ago. The blue line is what they're thinking right now. And this is a conservative estimate of the neutral rate at about 4%. And the FOMC's longer run neutral rate. This, remember, they want to get back to the 2. Now they're saying 2.5%, but they still would like to get back to that 2% level. This is just showing the G10. Yesterday I talked about the G4. Here's the G10 latest and 2024 consensus inflation rates. Here's the US. They're expecting us to still, according to the latest one, be at 8%. That's where we're at right now. They think that we're going to be between 2 and 3% when we get to 2024. Again, just a forecast. There's all kinds of variables that could come in and really change this whole scheme. Looking at the day's session, actually growth did better than value, where growth here was unchanged, but it was down 0.5% with the large caps. They were actually up with the mid caps versus the value, and up with the small caps as well. So we're seeing a little bit of internal improvement coming along right now. And I'll show you that as we go. And I don't know why the charts are freezing up here. With the down day, the VIX is still continuing to go up on a closing basis, and we're seeing kind of a breakout with the bar chart. Even though we closed off of the highest level, it's still going up, at least on a closing basis. The VIX of the VIX, because now the VIX is moving more, so the VIX of the VIX is starting to show more life as well. We're also getting to the point when you put an RSI 9 period on here that maybe we've gone up a little too far, too fast. And this could suggest that at some point, maybe the the VIX will top out given this extreme positive reading with the RSI. The fear gauge, called the ulcer index, it also continues to go up as we fall. We're down 24.31% from the all-time high. We saw a drop off in the equity put call ratio on the daily chart, and we're still seeing an increase over the last 5 periods and starting to put in a new spike, which could generate a new signal. And I have the full length chart to show you this later on. Here are the pivot points for Wednesday's session. And we're coming down to this level here. We actually broke a little bit below that, maybe took out some stop loss orders, and then we're able to come just slightly back above it. So we're still holding this level. We could even drop down a little bit more, but it's more important, where do we close with this? And with some of the other improvements that we're seeing, will that eventually, as long as we're going sideways, this has a potential of building some kind of a base. And then down at the bottom, you can see, even though we dropped off a bit in volume, it's still back above average. Here are the pivot points for the month of September. And just to show you, we're coming back down to a full retracement on our intermediate term Fibonacci chart. We broke a little bit below that, but we're still just slightly above that level currently. Longer term look, if we do keep going down, we might be getting down to the 50% retracement at about 35.10. I usually round these numbers up. But if support can hold, that would really help improve things a lot. But we're not really seeing support on this chart. Weekly, we could be coming down. If we still fall, we might come down to this moving average. That might provide some support, or we could come down to the 50% retracement at 35.07 and see if that might offer support if we continue to fall. We're coming down below the lower end of our trend channel here. Here's the midpoint, and we are dropping below that. But as I've stated a couple of times, just because we hit this point doesn't mean that all is lost yet. Now, if we continue to fall, pretty much wipe that out. And then if that lasts, if there's some real legs behind some kind of a decline, then that would make this more important than it is right now. Our sectors, kind of across the board, we had staples, utilities, and real estate down over 1%, where we had materials, discretionary, and energy was actually up a little bit, which has really been getting hit a lot lately. We don't have any technical analysis charts in the 90s right now. The best one is utilities at 87, followed by healthcare at 80. And then we have communications still down into the single digits or below 10. So here's the energy sector still holding up. We see utilities are starting to show some weakness, which could help the market as well with our ratio between the S&P 500 and the utilities. And then all of the other areas that continue to be negative since the all-time high. Here's an update of the percentage changes since the pink index. The S&P made its all-time high way back in January. Technical alerts, they were positive at the beginning where the NASDAQ went above 10.9 and then 11,000. The S&P got above 3,700. And then the rest of the day, we looked pretty negative, where we had the Dow set a 52-week low, the Euro's still falling to a 4-year low, the S&P set another 52-week low. A lot of our BPI, bullish percent index readings, are starting to get extreme negative. And then real estate, it also set a 52-week low. So we're seeing across the board weakness right now, but some of these are starting to show extreme negative readings. The Dow is looking the best right now, even though it's at a paltry 57. It declined a little bit in Tuesday's session. The S&P is in second place at 48.6, followed by the mid caps, which actually went up a couple of points in their technical analysis score. Small caps are pretty much flat at 36.2, and the Qs were up another 1.5 points and showing some improvement, but still pretty terrible overall at 29. Intraday, here was the gap up, and we went above R1. Never even came close to R2. We came down, and this is what I was watching at the beginning. We held right at the daily pivot. I thought, okay, we filled this little gap right here. Maybe we can try to go higher. Well, we went right back up to R1, and then everything fizzled out. So then we dropped below the pivot, went negative, came all the way down to S1, a little bit of a dip below this, but we held along S1. We did see some late day improvement. It wasn't more straight up like we've seen on other days, like here last Thursday and even last Friday, but there was some improvement. So we might be able to put this into the late day strength, that what the smart money likes to do quite often. Looking at our trend, we continue to go down, so the ADX is advancing. It's above the moving average. Even though the red line is declining, it's still on top, so that would be a negative trend. The Arun is starting to turn back up a little bit. We saw a little bit of an increase in buying. So it's just kind of creeping in slowly, at least according to some of our charts. But our breadth is still looking pretty bad. We saw a decline based on price and volume. Advanced decline ratio getting extreme negative. And the last time we saw a reading this low was during the COVID low. New highs, new lows continue to show weakness. Accumulation distribution also going more into the negative camp because we're below the moving average. Short term, this is where we're the most oversold. Going back 5 periods with the rate of change, we're still below this red line. So we are extreme negative. 10 periods, we're below this pink line, extreme negative, even though we're showing some improvement. The Stoke RSI, extreme negative. Williams percent R, extreme negative. Force index, not quite extreme negative, but close. Our Swinland trading oscillator, based on price and volume, we're dropping below these green lines, which is extreme negative. McClellan oscillator, even though it bounced, it's still extreme negative. Our moving average study, we're looking extreme negative with the 2050 and 200. All of our stochastics are extreme negative. Now, looking at the intermediate term, we're still coming down here. We didn't really see much of a change in this chart where this could be generating another signal. And this is one of our possible positive setups here. When we get a real spike down, and again, if you want to pause this and go back and look at other times when this happened, what did the S&P do after that? But we're hitting an extreme based on price and volume. Standard deviation still kind of far away from the price, but we ticked up slightly with the down day. Rate of change is still extreme negative. Sean trend meter turned up slightly, but still extreme negative. The PMO continues to be negative. Our PMO study, extreme negative with those that are rising, the buy signals, and those that are above zero also is extreme negative. The Chaikin oscillator continues to decline. Chaikin money flow also showing some weakness. Volume, it's not picking up as much, but we're a lot better than we were going through August. And the vortex with the red line on top continues to be negative. The summation index based on price continues to fall, and we're getting extreme negative based on volume. And all of our oscillators are now going down. BPI getting extreme negative and matching down to where we were at the June lows. Can we see some kind of a bounce up off of this? Ease of movement also showing continued weakness, as is the ultimate oscillator. The money flow index also negative with the CCI 14 and CCI 20, extreme negative, even though they're trying to bounce a little bit. RSI 14 getting extreme negative, as is the RSI 9 period. Boom indicator also extreme negative compared to the 50-day moving average, still declining with the 200-day moving average. Looking at Dow theory, we're setting new lows with the Dow. We actually saw a bit of a turn up with the transports, even though they've just seen an awful lot of weakness lately. We're seeing weakness in utilities, but they have not come down to this previous low as of yet. TTM squeeze is also looking more negative. Balance of power dropped below the dashed line. That's slightly more negative than it had been. We're still coming off of kind of an extreme reading with the CMB composite index, but we're waiting for this to turn back up and cross one of these lines. That would be a signal. Not happening yet. The Connors RSI, after going extreme negative, is showing some improvement. Our different charts, Heiken Ashi, negative. Kegi, negative. Renko, negative. 3-line break, negative. Point and figure, nothing was added to this. We're still working off of the triple bottom breakdown. Looking at the Elder Impulse, negative with the S&P as we are with the S&P ETF, SPY. The SAR continues to be negative with the dots on top. Go, no go, still negative in a deep purple state. Looking extreme with our longer term moving average study with the 50, 150, and 200. And the rate of change going back 200 periods, which is roughly a year, we're actually dropping below where we were at in June and getting back down to the point where we were at the COVID low. Special K continues to decline. And we've actually, I guess it's the Qs that have turned neutral. The diamonds continue to be negative. And here is the Dow currently. And here's the Qs turning back to blue, which is neutral. And we're holding right on this support level. And this is what I've been watching is watch the NASDAQ and watch the NASDAQ 100. If we start to see some real movement from those indexes, that's growth. And that could feed over into the S&P 500. And so far, this is holding up a little bit better. In fact, the NASDAQ 100 was up barely 0.16%, but it was up on the day. And here's the Vixen, which is spiking up a little bit, but we closed well off the high, but it's still going up slightly and getting to kind of an extreme reading as far as fear. Here's the NASDAQ. It was also up 0.25%, holding right below this current pivot level. The mid caps still showing weakness and setting new lows. The Wilshire, I don't know what this crazy bar is. It was actually more flat, even though it was down slightly in Tuesday's session. The dollar was up slightly and still just in a monster uptrend. Here's the British pound, where it really fell down, came back up a little bit and was actually up 0.4%, as the markets inevitably will overreact to things. Here's the S&P to the dollar showing they're going in opposite directions. Gold was up a little bit, but it's still in an overall pretty strong downtrend, and is silver, which was actually down slightly. Oil was up a little bit to 78.50, and S&P to oil, they both have a tendency to go down, so they're going in the same direction. And here is where the dollar is now outperforming oil, going back to the beginning of the year, where we have gold, stocks, and bonds negative since the beginning of the year. We're seeing a continuation of bond prices falling, and we're going just kind of in a free fall right now with the world bond index. As treasury yields continue to break out, here's the 10-year yield. It continues to expand. The 30-year yield, which is broken above the 61.8% retracement, going from the 2007 high down to the 2020 low. So this is a really long-term chart here. And stocks and bonds are having a real tendency to go in the same direction, which right now is down. And our yield curves, nothing really changed here. We actually improved a little bit, but the 10 to the 5 is inverted. The 10 to the 2 is inverted with a little bit of an improvement. The 30 to the 5-year, that's showing some more craziness, and it's inverted. And we're seeing some improvement with the 10 to the 3-month, which never did go inverted. The tech sector to the rise in interest rates, they're going in opposite directions currently. And here's this mishmash. It looks like it's just floating in the wind right now, where we still have the 2-year giving us the best yield right now, and then crossing over here in this tangled spaghetti mess currently as interest rates decide what they want to do. Just some updated charts. We're getting down to the low end with our possible positive scenarios, looking at those stocks above their 200-day simple moving average. That's starting to get extreme. And then with the 50, this is pretty much the same as what I showed in yesterday's video. Getting extreme with the S&P, mid caps, and small caps. So we're seeing kind of a convergence of extreme negative readings. The 10-day average of the highs minus the lows also coming down and getting rather extreme. Looking broadly across the market, we're also down to an extreme reading between the highs and lows, and then taking a 5-period moving average of that. We're spiking up now with the equity put call ratio. This was the chart at the beginning that I talked about, and this is the longer term look at that chart. Many times when we spike above 0.8, that will often marks a bottom in the S&P 500. So can we get some support from that? The small cap index continues to show weakness, and it's really underperforming the S&P 500. So this chart is not helping us at all. The S&P to the 10-year going in opposite directions, and we're seeing a little bit of an improvement with our sector rotation. See how the Qs to the S&P are going up, discretionaries starting to bounce back up, and large cap growth against large cap value is showing some improvement. And we're seeing the mid caps and the small caps showing some improvement as well. The correlation between the S&P 500 and the 2-year shows them going in opposite directions. As the 2-year goes up, the S&P is going down. And so we're just hitting new spike after new spike on this chart. And the ratio between the S&P and utilities actually bounced up slightly in yesterday's session. The staples sector was down 1.73%. And so we might come out and take out this spike, even though we did come back down in Tuesday's session. So what's our outlook then for Wednesday? We're negative and we're oversold. We have the MBA mortgage index coming out, the advanced international trade in goods coming out, advanced retail, as well as wholesale inventories, pending home sales. Not really big in the economic realm, other than the housing reports that we're getting. Russia, Ukraine, China, all those things, we want to keep those on the back burner, but it's still inflation and interest rates that are really driving the market right now. We'll have to see if we get any more Fed speak. Our scenarios, we have to go with the down scenario, but we are quite oversold right now. So that kind of takes the flare out of the down scenario. We can't go with the up scenario because everything's pointing down, and we should be seeing a bounce, but we're not seeing one yet. And what kind of a bounce is it going to be if we even get one? And we can't really go with the sideways right now because the ADX is above 20 and negative. So our conclusion, we're negative and oversold pretty much in all 3 time frames right now. So thank you. I hope you find this helpful. I'll look things over and see about preparing a video after Wednesday's session. So have a great day, and I'll talk to you then.